It is 1998, and a fund called Long-Term Capital Management is packed with Nobel Prize-level brains and beautiful models. They are not betting on one wild idea. They are betting on tiny spreads, small differences in prices that usually move back to normal. They use leverage, borrowed money, to make small edges look big. Then Russia defaults, liquidity vanishes, correlations jump, and the trades that were supposed to be independent all lose together. The question I want you to sit with is simple. Why did smart people keep adding leverage right up until the moment it broke? Leverage is a tool that multiplies outcomes, it multiplies gains, and it multiplies losses. It also multiplies emotions because it speeds up feedback. The human mind is not built for fast, leveraged feedback. We are built for slow learning, where mistakes are survivable. When leverage enters the room, survival becomes the first variable, even if your spreadsheet says otherwise. Most adults understand leverage in daily life. A mortgage is leverage. A business loan is leverage. Margin in a brokerage account is leverage. Options and futures are leverage. The psychological trap is that leverage feels like intelligence when it works. You look precise. You look efficient. You look like you are doing more with less. That is why leverage is so seductive to the ego. Risk is not the same thing as volatility. Volatility is how much prices wiggle around. Risk is the probability and size of a bad outcome that you cannot recover from. In leverage systems, the key risk is not a normal down day. It is the path. It is the sequence of returns. A 30% loss needs about a 43% gain to get back to even. A 50% loss needs 100%. That is drawdown math, and it becomes brutal when leverage turns a normal move into a deep hole. The psychology starts with overconfidence. Overconfidence is when I believe my skill is higher than it is, or my uncertainty is lower than it is. Leverage rewards overconfidence early. A few wins with borrowed money can turn a cautious person into a true believer. The brain starts to treat recent outcomes as proof. That is recency bias, the tendency to overweight what just happened. It is one of the main fuels of leverage blowups. Then comes the illusion of control. Markets give you numbers, charts, and execution buttons. It feels like a cockpit. But the hardest risks are not on the screen. They are in correlations, liquidity, and regime shifts. Correlation is how assets move together. In calm times, correlations look stable. In stress, they often jump toward one. Liquidity is the ability to exit without moving the price too much. In stress, liquidity disappears exactly when you need it. This is why leverage is not just a math problem. It is a behavior problem under uncertainty. Uncertainty means you cannot know the full distribution of outcomes. You do not know all the tails. Tail risk is the chance of extreme outcomes that live in the ends of the distribution. Leverage makes tail risk personal, because tails that were once inconvenient become fatal. LTCM is the classic case because the trades were not crazy. The leverage was. They were running huge positions relative to their capital. They had models that assumed certain relationships would mean revert. Mean reversion is when prices tend to drift back toward a typical level. The problem is that mean reversion can be slow, and leverage forces a clock on you. Margin calls do not care about your long-term thesis. A margin call is a demand for more collateral right now. If you cannot post it, you sell, often at the worst moment. That is the first psychological shift. With leverage, you stop thinking in terms of long-run expected value and start thinking in terms of staying alive today. Expected value is the average outcome over many repeats of the same bet. It is a good concept in casinos and in stable games. Markets are not stable games. You cannot always repeat the bet. Your capital is finite, and your investors are human. So the real objective becomes avoiding forced selling. Forced selling is where reflexivity kicks in. Reflexivity is when prices affect behavior, and behavior affects prices, creating feedback loops. A leveraged player sells because prices drop. That selling pushes prices down further. That triggers more selling. This is why leveraged markets can gap and why crashes feel like air pockets. Nick Leeson at Barings is another lesson in the psychology. A trader takes losses, hides them, doubles down, and uses leverage to try to win it back. This is not just fraud. It is human. Loss aversion is our tendency to feel losses more intensely than gains. When a leveraged position goes against you, the pain is fast and sharp. The mind looks for relief. It reaches for the most dangerous drug in markets, adding size to make the loss go away. That is a key point. Leverage turns a risk decision into an identity decision. If I am levered and wrong, I do not just lose money. I lose status, credibility, and the story I told myself. So I rationalize. I move the goalposts. I search for confirming information. Confirmation bias is when I seek evidence that supports my position and ignore evidence that challenges it. Leverage amplifies this bias because the cost of admitting uncertainty feels too high. There is also a quieter trap. In good times, leverage looks like discipline. You can run a market-neutral book, hedge this with that, and show smooth returns. Smooth returns are dangerous because they train you to expect smoothness. They also attract capital. Investors chase low volatility because it feels safe. That is the volatility paradox. Low observed volatility can invite higher leverage, which creates hidden fragility. Then when volatility returns, the system snaps. I think about 2008 here. The housing market did not need to fall much to break the system. The real problem was leverage on top of leverage, mortgages, then mortgage bonds, then leveraged holders, then derivatives layered over them. Many players believed diversification would save them. Diversification is holding different assets so one loss does not kill you. But diversification fails when correlations jump and everyone owns the same crowded trades. Crowding is when too many people are on the same side. In leverage, crowding is lethal because exits are narrow. Even great investors talk about leverage with respect. Warren Buffett has said publicly that leverage can turn a good business into a bad investment if you cannot endure volatility. I am not quoting him word for word. I am pointing to the principle. A strong balance sheet is a risk control. It gives you time. Time is the real edge in markets. Leverage steals time from you. On the trading side, Paul Tudor Jones is known for caring deeply about drawdowns and survival. Again, I'm not giving you a quote. I am pointing to a pattern among survivors. They treat leverage as something you earn the right to use, and even then they use it with humility. Stanley Druckenmiller has talked publicly about pressing when the odds are best. But pressing is not the same as reckless leverage. Pressing requires knowing where you are wrong and having the liquidity to exit. That brings me to position sizing. Position sizing is how big you bet relative to your capital. Most leverage disasters are not about being wrong, they are about being too big. You can be right and still go broke if the path hurts you before it pays you. This is why risk of ruin matters. Risk of ruin is the probability you lose so much that you cannot continue. In the real world, ruin can be a margin call, a redemption wave, or a psychological break that makes you stop following your process. There is a famous concept called the Kelly criterion. It is a formula for sizing bets to maximize long-run growth. In plain English, it tells you how much to bet when you have an edge and you know the odds. The problem is that in markets, you do not truly know the odds. Your edge is uncertain. Your distribution is unstable. So full Kelly is often too aggressive. Many professionals use a fraction of it because estimation error is a hidden form of leverage. The psychology of leverage also shows up in incentives. If a trader gets paid for short-term gains and does not fully pay for long-term losses, leverage becomes rational for them personally. That is moral hazard. Moral hazard is when someone takes risk because someone else bears the cost. In institutions, weak controls and misaligned incentives create leverage accidents. Barings was not just one person. It was a failure of segregation of duties, reporting, and oversight. Controls are boring until they are the only thing between you and ruin. I also want to talk about the body. Leveraged risk is physical. When your P&L swings are large, your nervous system reacts. You sleep differently. You check prices more. You shorten your time horizon. You become reactive. That is how leverage quietly steals decision quality. Decision-making under uncertainty requires patience and clarity. Leverage pushes you toward urgency. Urgency is not a strategy. So what do I do with leverage psychologically if I want to be a stable decision maker? I start by respecting that I can be wrong, and I can be wrong for longer than I expect. I assume my models are fragile. Model risk is the risk that my assumptions are wrong. I assume liquidity can disappear. I assume correlations can change. I assume a regime shift can happen. A regime shift is when the market environment changes, like moving from low inflation to high inflation, or from easy money to tight money. Then I treat leverage as a privilege that must be paid for with redundancy. Redundancy means extra capacity, extra margin, extra time. If I cannot hold through a normal adverse move, I am too levered. If I cannot sleep, I am too levered. If one headline can wipe me out, I am too levered. These are not moral statements, they are practical constraints. There is a final psychological trick leverage plays. It makes you confuse intensity with skill. Big swings feel like you are in the game. Calm compounding feels boring. But boring is often where the money is made, because boring keeps you alive. The market does not reward excitement. The market rewards staying solvent long enough for your edge to matter. When I look back at LTCM bearings in 2008, I do not see stupidity.